You're listening to Markets Radar with Jeremy Quintanilla. This is a show all about markets, stocks, crypto, bonds, foreign currency, and everything in between. And I try to give you my take on what it all means. And we have a great show in store for you. It's coming in a little bit later. Not only did I have a bunch of meetings this morning, but I also wanted to take the time to wait for the earnings on SpaceX because everybody is wanting to see what's happening. And I'm just going to say I have a crystal ball on what actually happened, or what actually happened is what I guess what actually happened. And I'm not sure why anybody thought otherwise than what actually happened with this SpaceX first earnings for quarter two since it went public, and I'm excited to see this. Now, that doesn't mean that I'm not a long-term visionary and think that SpaceX can become something. All I'm saying is it is highly overvalued due to the CapEx expenditures that it is a part of to build out its AI infrastructure. So we're going to talk a little bit about that. We're going to talk about Caterpillar's AI surge. Yes, Caterpillar, the construction company. We're going to talk about Wall Street's quiet crypto grip and corporate tokenization. So I'm excited to have this show with you today. But before we jump in all of that, make sure that you follow me at Age of Jeremy on Instagram. You can also join my broadcast channel, Dope Insights and Updates. Still working on building out a strong plan for that. My main focus right now is making this one of the main shows that's part of the Age of Jeremy empire. And some of the changes as it relates to the production company for the things that I do. And also really focusing on becoming a financial educator or a better financial educator in the space, because we coach thousands and thousands of warriors through 3T Warrior Academy. So head on over to 3twarrioracademy.com or follow Coach JV _ social media so that you can learn about our Capital DR system, and maybe it'll make sense for you to get coaching with us, or at least join our academy and be a part of the community. Also on the Financial Coach JV podcast channel, or the Coach JV podcast channel. This last Monday, I was on the War Room. That was actually yesterday. Yesterday I was on the War Room. Go check out that show where we break down and have commentary on things that are going on in the economy, both macro and micro level events that are happening in the economy, and we have some great conversations. Coach JV was out for the week, so I had that with my good friend Jackie on the show, who's our Chief Investment Officer for the 3T Warrior Academy. And we're also going to be back again, as always, on Friday with the new Wealth Transfer podcast on the Financial JV YouTube channel. So make sure that you check that out. And you can also listen to those bad boys wherever you get your podcasts. If financial education isn't your thing and you want some more fun, exciting entertainment, I have a show called Mercury where we talk about podcasting and other pop culture news. And we have a lot of great things in store from that area of my empire, my media entertainment empire that is Age of Radio. So go check that out as well. But I want to talk about markets. And today we are leading with a financial drama unfolding at the little intersection of earthbound capital and deep space ambition. Elon Musk's rocket, satellite, and artificial intelligence conglomerate, SpaceX, released its highly anticipated first ever quarterly earnings report since its historic stock market debut in June. It was the most closely watched corporate report of the year. In June, SpaceX pulled off the largest stock market debut of all time, which goes to prove that buying politicians can benefit you and get you into the NASDAQ 100, which is where Age of Radio will be one day in the future. So I'm excited about that. Hopefully sooner in the future than further away in the future, but we have a lot of work to do to get to that part. And I hit my hand on the microphone. So hopefully that wasn't too loud on your ears, because you probably heard it and or felt it, depending on how much bass is on your, I guess, earphones. I was going to say in your car, because I listen to most of my podcasts in the car. Really working on listening to more podcasts everywhere, because podcasting and listening to podcasts is my jam. Now, again, it pulled off massive $86 billion, raised a massive $86 billion and instantly valuing the mega conglomerate at a staggering $1.6 trillion. That valuation catapulted SpaceX post a host of traditional mega cap tech giants and made it larger than Musk's own Tesla. But the afternoon of this blockbuster debut has been a wild post-IPO roller coaster ride. Initial volatility and broader sell-off in AI stocks erased over $1 trillion in market value from its peak, costing Elon Musk his status as the world's first trillionaire. And as we went into Tuesday's trading, all eyes were on whether SpaceX fundamentals could support its astronomical valuation. On paper, SpaceX debut earnings was an absolute home run that handily beat Wall Street's consensus expectations. The company reported a blowout second quarter revenue of $7.8 billion, easily surpassing the $6.81 billion that analysts polled by Bloomberg had expected. On the bottom line, instead of the wide 24 cents per share loss Wall Street anticipated, SpaceX reported a net loss of just 9 cents a share, which is great. Even if its highly scrutinized AI business unit performed better than feared, posting an operating loss of $1.26 billion, which was nearly 50% better than the $2.39 billion loss projected by analysts. So with blowout revenue and narrower than expected losses, you would expect the stock to soar, right? Wrong. In U.S. post-market trading, SpaceX share tumbled by as much as 8.8%. Why did Wall Street turn on a company that just beat expectations? The answer lies in two words: capital fucking spending, which is what I've been saying is the biggest problem with AI. Investors were absolutely blindsided by the sheer scale of SpaceX's splitting splurge on artificial intelligence, which my guess is that eventually I imagine that they will get their shit together with XAI. But you all know that I'm a huge fan of Google and Sundar and everything that Google is doing right now. And I actually think Apple is starting to get their shit together as it relates to AI. So I don't know where SpaceX Fix or XAI is going to fit into all of this. The company disclosed that capital expenditures jumped to $15.8 billion in the second quarter, while total capital spending soared to about $18.4 billion for the quarter. To make matters more tense for investors, executives told analysts on the call that this highly intensity capital spending will not slow down, with spending in the third and fourth quarters remaining at the same elevated levels. This is a spending race to see who can do it the fastest and the best, and my bet is still on fricking Google. Compounding that anxiety, more than $100 billion worth of stock becomes eligible for sale later this week as post-IPO lockout periods expire, potentially dumping more downward pressures on the stock. If you look past the immediate stock market freakout, you begin to see the enormous multi-billion-dollar commercial architecture that Elon Musk is building. SpaceX is not just spending this money on empty compute, they are building a massive cash-generating AI business. On the conference call, executives revealed that SpaceX has already contracted for an incredible $6.7 billion in cloud services revenue so far in the third quarter alone. Now, some of that is, I believe, coming from Alphabet and Google. Google's agreed to pay SpaceX a jaw-dropping $920 million a month under a cloud service arrangement that runs all through mid-20 and 29. Why through mid-20 and 29? Because they're working on their own infrastructure for TSU compute, which means that Google will be able to handle its own infrastructure and will be working to create an infrastructure or a TSU subscription business is my bet and my guess. So where is that going to leave SpaceX after that? I believe that Google is one of the most undervalued players in this space. And I also think, like I mentioned a second ago, Apple's probably getting back up there, but not from an infrastructure perspective. They're going to do a really good consumer move and how to integrate AI into consumer technology. And Apple's also kicking ass because of their essentially subscription business model for upgrading your iPhone. So when we think about the nearly $1 billion a month from a single customer, SpaceX has also signed a similar heavy-duty cloud computing agreement with Anthropic. My guess is they have this still with Anthropic Google's going to get their shit together over the next couple of years, start renting their own infrastructure out, and also being able to handle their own compute. And then they're going to get Anthropic to come over to them. The explosive build out is the direct result of rapid rebuilding effort. Back in February, SpaceX officially merged with Musk's AI startup XAI, which had burned through $6 billion last year and fallen behind rivals on coding and adoption, because who gives a shit about Grok, even though it's got the best name in the marketplace? I can't lie. Elon does a really good job with names. Me and him are probably kinsmen. I don't know. We agree with those types of things and like cool cyberpunky and science fictiony terms. In June, SpaceX shored up its software efforts by acquiring the popular coding AI startup Cursor for a staggering $60 billion. Anti-gravity is built off of Microsoft's VS Code. Go check out Google Anti-Gravity. I think Anti-Gravity is the best play to go. And Lovable, I'm hearing a lot of great things about Lovable. And who doesn't love Swedish companies? Lovable is a beautiful Swedish company. Now, the Cursor thing... just last month, that combined powerhouse released its flagship Grok 4.5 model, focusing heavily on coding, finance, and legal tasks. Musk claimed on social media that Grok 4.5 is now fully comparable to Anthropic's flagship Opus 4.7, which hit the market in April. Wall Street might be nervous about the cost, but Musk is paying for absolute dominance. To support this massive software empire, SpaceX is leveraging its undisputed monopoly on space infrastructure. The backbone of this is Starlink. That's where the biggest play and biggest bet, in my opinion, is here in space. Not biggest bet. I think this is the thing that should be its own business. They should spin off Starlink as its own specific company, and Starlink will be very profitable. Starlink is, in my opinion, one of the best things that he's made. Starlink beams down high-speed broadband to consumers, governments, and enterprises globally, powered by a constellation of more than 10,000 satellites orbiting close above the Earth. By second quarter, Starlink reached 12 million active subscribers. While that was technically just below the 12.19 million that the most bullish analysts had hoped for, Starlink's momentum is undeniable. Chief Operating Officer Gwynne Shotwell told analysts that the company is actively preparing to build out terrestrial mobile infrastructure, paving the way to launch a highly anticipated direct-to-mobile satellite service. But the true flywheel for all of SpaceX ambitions is Starship, the most powerful rocket ever built. Starship's development has been a rocky, highly expensive path marred by spectacular explosive setbacks and delays at a cost of $15 billion and counting. But on July 24th, Starship staged a highly successful test flight, deploying satellites and returning to Earth largely unscathed. Musk told analysts that the new heat shield appeared to be extremely robust and declared that a year from now, he expects SpaceX to be launching Starship at least one a day. Royal Bank of Canada analyst Ken Herbert highlighted this in a July note, writing that Starship remains the central flywheel and that the massive cost savings from Starship will be the ultimate catalyst to unlock the global connectivity and orbital compute markets. So I think that if they can do that and create that, then I think, again, like I said, I'm not bearish on SpaceX. I'm bearish on the current valuation of it. Long-term capacity, if you can hold this out, Elon Musk will find a way to make this beneficial. People will win on buying SpaceX. It just depends on when is the right time to buy. I don't think the bottom on it is in yet. And that brings us to Elon Musk's ultimate jaw-dropping long-term plan, pioneering space-based data centers, which I agree with. I don't think that it's too far out there. People make fun of that. One of my people that I love, Professor Galloway, he's joked about this specifically. I think that this is something that we should be focusing on if we're going to focus on AI infrastructure. The problem is this: from an environmental standpoint, we need to find a better way around this. But for the purposes of business standpoint, this makes a lot of more sense. In fact, Google has talked about this specific. They have a project and a white paper on what this could look like in the future of bringing satellites or data infrastructure into space. As tech giants build larger and larger artificial intelligence clusters here on Earth, they're hitting severe physical limits. Terrestrial data centers are facing extreme resource, land, and energy constraints. Musk's solution: stop building them on Earth, launch them into space. This expensive and largely unproven strategy would entail launching a massive network of orbital satellites that rely on constant, unfiltered energy from the sun to compute data in orbit and then beam that back down to Earth. It sounds like science fiction, but as Royal Bank of Canada's Ken Herbert noted, orbital compute is the next logical step, and I agree with that. And whether or not I agree that it's like the best for the universe as a whole, I agree with that as the next logical step. And whether this grand space-based vision takes 5 years or 15, the underlying message is clear. The energy bottleneck is the single biggest threat facing the artificial intelligence boom today. But while Elon Musk shoots for stars to escape Earth's energy constraints, down here on the ground, traditional companies are capturing a historic windfall by powering the terrestrial data center boom right now. And that brings us to our next segment and the ultimate ground level power play: industrial giant Caterpillar's historic earnings blowout. We'll be right back. Let's talk about Caterpillar. Not the kind that turns into a butterfly, but the kind that digs beneath the earth and pulls the dirt up and moves it. And good old large equipment, dirt removal, stuff that I love. Man, equipment is where it's at. I love equipment. I don't know if I've ever told any of you that. I'm so excited to get into the equipment business, but that might have to be pushed off for a little bit based off of some things that we're trying to do in some of our other businesses. But you're not here to talk about that. That's what the Age of Jeremy regular feed is for, which comes out on Wednesdays. Tomorrow's episode is going to be all about how I want to be looking sharper as a professional. And we also talk a little bit about radishes, not the kind that you put in your mouth, but Radish, the app that is trying to replace the 401k by, get this, the person that founded the 401k and created the 401k realize that it does not help the middle class the way that he wanted it to. And he's working on another product called Radish. And I talk about that on the Age of Jeremy feed, which will be out tomorrow morning, as long as I can get this episode out and then edit that episode to get that out as well. So lots of stuff to do. So let's go ahead and talk about Caterpillar. When most people think of investing in artificial intelligence, they think of high-flying software, Silicon Valley chip makers, and complex large language models. But we're going to talk about Caterpillar. They released a blockbuster second quarter earnings report that handily smashed Wall Street's expectations. The CAT stock, Caterpillar's stock ticker is CAT, soared on the news, up over 8% in early trading, calming investors after weeks of intense market volatility. So we're going to dive deep into Caterpillar's record-breaking numbers to understand why this heavy machinery legend has quietly become one of the most vital and lucrative backbone players of, you got it, the artificial intelligence revolution. Now, let's look at the eye-popping numbers that Caterpillar just posted for the second quarter. Wall Street was expecting a solid but modest quarter. Analysts had penciled in earnings per share of $6.22 on sales of $19.3 billion. Instead, Caterpillar blew those estimates clean out of the water. On Tuesday, the heavy equipment maker reported an astonishing second quarter earnings per share of $8.17, nearly $2 full above expectations. That massive profit came from a record-setting $20.5 billion in sales. To give you a sense of the scale and velocity of this growth, just look at where Caterpillar was a year ago. In the second quarter of last year, CAT reported earnings per share of $4.72 on sales of $16.6 billion. We are looking at a year-over-year earnings per share surge of more than 73%. Now, Joe Creed, Caterpillar's chief executive officer, put the milestone in historic perspective, stating, "This is the first time in company history that we have generated over $20 billion in sales and revenue in a single quarter. Creed attributed this landmark achievement to strong order rates and a growing backlog that reflect broadening momentum across all three of Caterpillar's primary business segments. First, construction industries led the charge in absolute size, with sales rising a staggering 35% to $8.3 billion. Resource industries, which covers mining equipment, grew by 20% to $4.6 billion. But the segment that has the entire investment community talking is the all-important power and energy business, which grew 17% to $8.2 billion. While construction and mining are highly cyclical, traditional industries, the power and energy segment is being supercharged by an entirely new secular growth engine, the massive building boom of artificial data centers. AI is incredibly power hungry. These next generation data centers require immense uninterrupted streams of electricity to run millions of high performance chips, cool massive server racks, and keep the digital world turning. And when these data centers need backup power to prevent catastrophic outages, they turn to ultimate gold standard in heavy duty electricity generation. Caterpillar. Caterpillar's large industrial generators and turbines are the physical backup engines keeping the cloud alive. And as the AI race intensifies, tech giants are ordering Cat's massive gen sets at an unprecedented pace. Now, the data center power boom didn't just start this quarter. If we look back, the warning signs of this massive surge were earlier this year. And if you've been listening to Markets Radar and or the Age of Jeremy, I've been saying you need to look at sectors that tie into AI because they too will start to boom as these things continue. Now, I didn't specifically say this type of what's the word I'm looking, correlation with something like a Caterpillar. But this is the reason why I've been talking about this for so long, is because if you're wanting to be good at investing, you need to be able to look at an industry and find out if something's booming in some industry, how will that affect the growth in other industries? Caterpillar's power and energy segment generated $7 billion in sales, which was up 22% year over year. But if you isolated just the power generation subsegment within the business, sales were up a jaw-dropping 48%. At the time, Caterpillar's management team explicitly stated in April that this 48% power surge was driven by strong demand for large gensets and turbines used in data center applications. They also noted an increasing product mix shift toward prime power, meaning these massive generators aren't just sitting idle waiting for emergencies. In some cases, they are being integrated directly into the primary power infrastructure of these tech hubs. This brings us to a fundamental investing lesson of the artificial intelligence age. To build the future, you cannot just rely on code and software. You need physical space, steel, concrete, and above all, electricity. By focusing on the companies that surround and enable AI, like the physical power providers, investors are discovering a highly profitable strategy that sidesteps the intense competition of the actual software wars. But this dynamic has also turned Caterpillar stock into an absolute battleground for Wall Street, characterized by some incredibly wild rides. Before Caterpillar reported its first quarter earnings back on April 30th, the stock was trading around $810. The Q1 blowout report sent shares up nearly 10%, kicking off a massive wave of AI-fueled excitement. In the weeks that followed, the stock traded as high as $1,073.46 as AI data center euphoria peaked. But the euphoria also faced fierce pushback. As investors debated how long this building boom could last, the stock tumbled as low as $776. The dramatic swings caught the attention of prominent market bears, including Michael Burry of Big Short fame, who reportedly downgraded and shorted Caterpillar stock following the first quarter release. Coming in Tuesday's trading, Caterpillar stock was up an incredible 91% over the past 12 months. This monumental rise significantly expanded Cat's valuation multiple. In late 2022, right when ChatGPT was first released to the public, Caterpillar traded at a modest 15 times expected earnings. Today, it trades at roughly 27 times expected earnings. That is a massive valuation premium for an industrial machinery manufacturer, reflecting just how deeply Wall Street has recategorized Caterpillar from a traditional manufacturing firm into a premier AI infrastructure play. What Caterpillar's blowout second quarter proves is that the physical constraints of AI are real, and the companies that can solve those constraints are capturing massive windfalls. Whether Caterpillar can maintain this historic pace and whether it can justify its expanded 27 times valuation multiple remains an open question that will keep bulls and bears locked in a fierce tug of war. But one thing is undeniable: the road to the artificial intelligence future is paved with steel and is powered by Caterpillar. We'll be right back. If you only look at the retail headlines, you'll see that Bitcoin is currently mired in a prolonged grinding bear market. Today, this was recorded on August 4th, Bitcoin is trading at around $63,000. I wish it would get under $62,000. That's when I have my entry point to go and buy more of Bitcoin, because I love me some digital assets and I love me some Bitcoin. But let's start with some hard data that proves there's an institutional shift isn't just a theoretical trend. It is a concrete reality. There's a lot of naysayers about how cryptocurrency will not be a part of the main financial infrastructure. Now, according to a recent report from the prominent trading firm Wintermute, institutional investors accounted for a massive 72% of spot trading by volume on Wintermute's over-the-counter or OTC desk in the first half of 2026. Let that number sink in. 72%. Just a year earlier, in the first half of 2025, that institutional share stood at 59%. This dramatic leap in professional dominance is happening even as overall cryptocurrency trading volumes have weakened across the global cryptocurrency market. And what this says is that while retail traders have pulled back and checked out during this prolonged price lull, hedge fund, asset managers, and large-scale corporations are staying engaged and stepping aggressively into the void. Essentially, Wall Street is becoming the market's primary source of liquidity, and as these institutional players dominate, they're doing something retail momentum traders never could. They are dampening crypto's trademark volatility. The chaotic 100% daily price swings of the past are being replaced by systematic institutional liquidity. Capital is becoming increasingly concentrated in the hands of highly sophisticated counterparties, transforming crypto's market structure from a speculative retail playground into a mature institutional arena. But how exactly are these institutions gaining their exposure? They aren't behaving like the retail investors of old, and they aren't opening up personal exchange accounts or holding raw tokens in private digital wallets. Instead, professional traders are shifting their strategy. Rather than buying spot tokens outright, they are increasingly utilizing derivatives, structured products, and exchange-traded funds, or also known as ETFs. This shift is highly evident when we look at the options market. Wintermute's OTC desk reported that altcoin option volumes more than tripled in the first half of 2026 compared to the second half of last year. However, unlike retail traders who chase hundreds of speculative tokens, institutions are proving to be far choosier. They strictly prioritize highly liquid assets. To put this into perspective, according to Wintermute, the variety of tokens traded by professional counterparties grew by just 24% over the last 2 years. Compare that to retail investors, where the variety of traded tokens expanded by a staggering 76%. Wall Street is laser focused on liquidity and risk management, concentrating its capital in a highly select group of digital assets. The deliberate approach is driving a massive wave of preparation. Alistair's Bias Perry, the head of capital markets and investment for Europe, the Middle East, and Africa at 21 Shares, recently noted, and I quote, "We're actually seeing more due diligence from asset managers and wealth managers. This is not speculative FOMO or fear of missing out. It is rigorous institutional financial evaluation." And this quiet institutional takeover isn't just limited to hedge funds. And it's not limited to hedge funds and or investment managers. The world's largest traditional banking giants are stepping in to build their own regulated blockchain-based financial plumbing. And this is the key of what I wanted to mention, is that the banks are going to continue to build in this space. Wells Fargo, the fourth largest U.S. bank by assets, has announced plans to launch tokenized deposits for its corporate and commercial clients this coming fall. This represents a monumental step for mainstream financial institutions. These tokenized deposits represent traditional bank funds as digital tokens on a private blockchain. This allows corporate clients to transfer, program, and settle funds 24 hours a day, 7 days a week. This is a real use case from a real financial technology. At launch, Wells Fargo's program will cover US dollars and British pounds for cross-border payments. Chief Financial Officer Mike Santomassimo reported that the bank plans to expand the service next year into more countries and currencies depending on client demand. Wells Fargo is running these deposits on its own proprietary blockchain, which Santomassimo notes gives the bank far more control over its destiny. But next year, a consortium of major U.S. banks plans to launch a unified industry-wide tokenized deposit network, and Wells Fargo has designed its system to seamlessly integrate with that network. This places Wells Fargo right in the middle of an intense technological arms race, competing directly with JP Morgan Chase, JPM Coin, and Citigroup's digital assets products. There is a critical strategic battle here. Banks heavily favor tokenized deposits over public stablecoins. By building their own tokenized deposit infrastructure, big banks are creating a regulated institutional alternative that captures the speed of blockchain while keeping the capital safely within their own vault walls. They are capturing the future of digital liquidity on their own terms. The combination of Wall Street's trading grip and traditional banking tokenization has resulted in one of crypto's most atypical drawdowns to date. In previous market cycles, a 50% drop from a historical peak would trigger a violent, chaotic repricing, a panic selling spiral that left the market in complete disarray. But this time is different. While Bitcoin is indeed down about 50% from its peak, over $126,000 last October, the descent has been a steady, systematic decline rather than a wild crash. As Stephen Coltman, the head of macro at 21 Shares, puts it, crypto is trading like any other asset class now. It has matured, behaving more like traditional finance, and probably apart from meme and altcoins, but for the main coins, they behave this way. Yet, even as retail participation is subdued, some individual traders remain completely undeterred by the price slump. Take Adam Potamkin, a 30-year-old paramedic based in Miami. Potamkin recently bought Bitcoin when it was much more expensive, closer to its May high above $82,000. Reflecting on this grinding market, he recited a mantra popularized by Strategy Inc. founder Michael Saylor, which invokes the mysterious creator of Bitcoin. Volatility is Satoshi's gift to the faithful. When asked if his conviction has been tested during this drawdown, Potamkin was candid. He said, "Absolutely. The world feels shakier, and we're still trying to figure out how to value this asset." It is a fascinating contrast. Wall Street is managing digital assets with cool, calculated risk models, while the remaining retail faithful are holding on with sheer ideological conviction. Whether you look at it through the lens of Wall Street asset manager, a corporate treasurer utilizing Wells Fargo's tokenized cash, or a dedicated Miami paramedic, one thing is clear. The crypto market of 2026 is not the crypto market of 2021. It is more mature, more professional, and deeply integrated into the global financial system. The Wild West era is giving way to a structured, institutional-driven market, which is going to continue to happen if clarity eventually passes. But I talk about that on New Wealth Transfer Podcast and on the War Room, and I don't think that the Clarity Act is going to be done this year, or at least not until after the midterm elections. But that will help usher in more and more infrastructure to help make cryptocurrency a mature asset class. And the key here is that if you're listening to this and you're not into cryptocurrency, I keep urging people to get involved with understanding it, maybe even investing in some of it, so that you can understand that this and the technology behind blockchains will continue to be there in the future, and it will continue to be integrated in the financial infrastructure of the United States and around the world. And as I always say, be thankful, grateful, and kind. We'll talk with you soon. Bye.